Thank you very much, Ian. I really appreciate the insights. And as you said, we launched the Zurich Alpha Savings Club last year, and we've been getting phenomenal kind of support in it, which is based on the savings plan that I alluded to, and it's really focused on helping people to save over the medium to longer term, and by that I mean typically kind of 3 years and longer. I don't believe that it's really sensible for anyone to invest for any period less than that. So Ian, I'm just going to ask a few questions. We did get some questions over the course of the week. And if it's okay, I'm just going to kind of pepper a few at you.
Yeah.
I forgot to mention at the start that we are running a poll. I can see quite a few of you have been answering about, there's a question just asking how much do people usually save a month. So I'll put the results of that up at the end. But Ian, just for anyone who hasn't kind of saved into the type of products that we've been discussing, can you just give a kind of a view as to how you'd compare them to, say, the traditional kind of bank, post office, or credit union, please?
Yeah, so I think the first thing is, and I know this yourself and the rest of the team would be impressing this on people, it's always good to have an emergency fund, and that should be in somewhere safe like the post office or the bank account. However, when we look at things for longer term, so as we say, 7 or 10 years plus for a child's education, for example, there's loads of money on deposit, so Irish people are saving more than they ever had. It's earning less money than ever because of the interest rate environment we're in. And we're also seeing inflation start to bite. So we're seeing higher inflation in Ireland than we've seen for the last 20 years. So I do believe that a large part of the Irish public are changing their mindset in terms of how they might save for the longer term. And those points around deposits, rates and inflation are pushing people to take a look at this. And I think that's a good thing. So very different, but a positive move.
And Ian, you showed on one of the slides about the recent pullback, which obviously is termed as a correction, and the way in which markets have performed over the last number of years, which has been phenomenal. And Zurich have been a fantastic manager, the best in my opinion. But what would you say to somebody who's worried about maybe investing at this time in respect of what they think could continue, i.e., this downward movement over the next 6 to 12 months, for example?
Yeah, do nothing if you're already invested is usually a good starting point. It does hurt. There are behavioral bias, as I said. Sometimes we have a strong urge to do something, but stick to your plan. I would always suggest, if somebody has concerns, is to pick up the phone or drop you guys an email, and you can talk through it. If your circumstances haven't changed, your plan doesn't, even if things are changing in the world. And look, I'm a big man for statistics. So in the last bull market, we had 11 years, and we had a correction or a 10% pullback in 8 of those 11 years. So there's lots of reasons to take you out of markets, but just stick with the plan and ride through it.
And on a more general note, Ian, for people who are, I suppose, saving for different reasons, whether it be for a deposit for a house or for their kids' education or for their pension, how would you kind of, I suppose, judge the risk levels that someone should have? So, for example, if it's a longer term investment for their pension versus something that's shorter term.
Yeah, I think with the pension, it can be sometimes easier if you have that longer time frame. Is pick something relatively high risk up the scale and set and forget. You can put the money away, and that power of compounding when we show the different ages, the start dates, I think that's really, really important. Also, pensions these days, you're probably going to continue to have an investment fund or a pension product in retirement. And we're going to all live longer on average than the last generation as well. So with pensions, I think invest early and often. There is an amount of risk that you would take or should take in terms of saving for a house deposit or the child's education. But just looking at one of the questions coming through, if that's in 12, 18, 24 months, that's a very short time period. So taking risk isn't really an option there. But once you're out over the 7 or 10 years, a lot of the same principles remain the same, or are there as well. Take sufficient level of risk, check in with your advisor before you do anything, and stick with the plan.
Very good. And Ian, there's a lot been spoken about the environment and obviously what's classed as ESG investing, which is, environmentally social governance. And can you just give us a kind of a very quick house view on Zurich's approach and whether you're likely to launch funds or what your general view is on this?
Yeah, so ESG and climate change and responsible investment, sustainability, these are lots of phrases we're hearing in the industry, and so we should be. There's a lot of regulation coming down. We'll have seen some of the plans from the European Union on the back of COP26 and things like that. So we do have an ESG strategy. We've had ESG as part of our investment process since 2012. I mentioned that we're an active investment manager. I think that's important. So when we invest in different companies, we have the ability to go talk to them, make sure that they have a climate, a carbon reduction plan, things like this, and we can choose not to invest in them. But we very much like to engage with companies and help them along the journey rather than just exclude them. That would be a big thing for us. But in general, we are making some changes and looking at things within our funds, but also very much aware of sticking to the consistent investment process that has served clients well for over 30 years. But in summary, it's a topic that's going to stay on the agenda, I believe, for the foreseeable future.
Okay, very good. And finally, Ian, for me anyway, just I suppose for anyone that's not familiar with Zurich, and I'm going to, I suppose, pin you to the wall here. Why would you recommend Zurich over any of your competitors? Obviously, for those people that maybe have investments elsewhere or indeed haven't been exposed to Zurich. So here's your opportunity to maybe plug Zurich for a few moments.
Yeah, look, I think the track record speaks for itself in terms of the investment side, but a couple of things we would always point to is the strength of the company. You know, and we are a very large global Swiss insurer, and we have a very consistent approach to how we manage money. We don't chop and change it. Active top-down approach has been in place for over 30 years, and we've been a constant in the Irish market since the 1980s with these sort of multi-asset funds. And I think ultimately what that really means for me is we've been there every step of the way, through the financial crisis, through COVID, through the dot-com bubble. And so we've been through thick and thin with it. And as I said, been at it for over 30 years and definitely will be for the next.
Super. Okay, well, I'm going to sort of have a look and see if there are any questions, or if anyone wants to ask a question, please feel free to raise your hand on the chat. I think I saw somebody with a raised question, but one of the questions I can see here on the chat, Ian, and I'll throw them at you if you don't mind, is is the market going through some more turbulence this month?
Yeah, definitely. So in a nutshell, what we're seeing here is that high inflation that's around the globe in the US. The central bank, called the Federal Reserve in the US, are now going to raise interest rates in America. And that's caused some turbulence, as the question says, in the US stock market. The view from Zurich is that equities can come through this. They just have to digest this news, come to terms with it, and they hopefully can move higher again. But if I was to point to one reason why we've seen a bit of a downturn at the start of this year, it's very much that relationship between inflation and interest rates.
Okay, very good. This is one, Ian. It asks about, I suppose you mentioned earlier about technology companies and the fact that whilst, you know, generally they've performed really well, they've suffered a small bit since the start of this year. What's your general view on the tech stocks, just as a market?
Yeah, so we still do like technology stocks. I think it's worth noting, though, that that's a really, really broad church. There's software as a service, there's semiconductors, there's hardware, there's cloud computing, things like this. So when we say we like it, the sector, we do like technology, but we're very, very selective in that as well. So as an active manager, we're trying to pick certain companies in those sectors. So growth stocks do get hit with this interest rate narrative that's unfolding. But it's also, we like a company, we're willing to stick with it, and we'll hold it, and we'll have conviction in our views as well. So we would still we'd be selective, but optimistic on parts of the tech market. Yeah. Okay,
very good. Funny enough, I was listening to Owen McGee, who I used to work with, funny enough, a long time ago. And I know Owen spoke in a Zurich webinar that I was on earlier in the week. And he talks about this 60-40 rule. Now, I don't want to make any judgments about different investment strategies and so on, but he was referring to, I think, 60% invested in the market and 40% in bonds. What's your general view on bonds in overall, Ian? I know you said you were generally not as positive about bonds and equities, but just for people out there that maybe are not sure about which asset class they should be invested in.
Yeah, so bonds will be in general lower than that risk scale than equities. but you can still lose money in them, even if something's less volatile. When we look at this changing interest rate environment, as interest rates go up, or people think they might go up, bonds lose value. And that's kind of the environment we're coming into at the moment. And we've not been in that environment, particularly in the Eurozone, for a long time. So still less volatile when we're looking at government bonds. But the idea of de-risking definitely the bonds at retirement or close to a child's education, etc., some of that theory is being challenged a bit at the moment. And we're making particular decisions again as an active manager to make sure we protect our clients in that sort of environment. But overall, a lot of the theory we think about bonds might be shifting. So we're cautious.
Very good. Well, listen, I think that's about it for time. Thank you very much, Ian. I know there's a few questions that haven't been answered, but we will endeavour to get back to them. So we'll be responding. Just to mention, we are doing a follow-up Zoom session on income protection, which is another product that Zurich have just launched to the individual market. They've been providing that to groups, and that will form part of the session which we're doing on Wednesday the 16th of February. And we will do more of these as we go further into the year. But look, I'd like to thank you all for your time. Thank you very much, Ian, for giving your time and your thoughts on the topic, which is really interesting. And